Welcome to Macro Money Talk. Today we investigate the artificial intelligence market to answer the ultimate financial question. Is this a massive bubble? Everyone is talking about AI, comparing it to the dot-com crash. But the reality is far more complex than simple historical patterns suggest. We see stock prices soaring to the moon, yet investors remain divided between optimistic future growth and the fear of a sudden collapse. To understand where we are going, we must first dissect the two opposing arguments dominating Wall Street: the bull case and the bear case. Let us begin with the bull case. Proponents argue that this time is different because the underlying financial foundation is incredibly robust. Unlike the late 90s, the money pouring into AI today comes from massive tech giants with real profits, not debt-ridden startups. Back in the dot-com era, speculation was driven by companies with no revenue, burning cash on wild ideas that never materialized into products. Today, the investment is driven by balance sheets that are flush with cash, allowing these corporations to absorb risks that would crush others. The second pillar of the bull case is immediate utility. AI is already being used by millions to automate coding and writing tasks. The internet took years to become truly useful for the average person, whereas AI tools have delivered instant value from the very first day. We are witnessing the construction of a sustainable infrastructure built on advanced cloud computing and powerful GPU chips that power the modern world. Even if specific AI software projects fail, this physical infrastructure will remain, serving as the backbone for future technological advancements and computations. This tangible utility and infrastructure build-out suggests that we are investing in real assets, not just empty promises or vaporware concepts. However, we must now look at the dark clouds on the horizon. The bear case presents a terrifying reality that investors ignore. The first major warning sign is actual performance. 95% of companies integrating AI report no improvement in productivity or efficiency whatsoever. Only a tiny fraction of businesses have seen real profit returns, which contradicts the massive hype and trillions of dollars currently being invested. We expected artificial general intelligence to solve cancer and climate change, but instead we received sophisticated tools for generating internet memes and spam. This gap between the expectation of world-changing intelligence and the reality of entertainment chatbots creates a dangerous valuation bubble in the market. The operational costs are staggering. Companies like OpenAI are burning through cash because the energy required to run these models is astronomical. Every single question you ask ChatGPT costs the company money in electricity and computing power, making the path to profitability extremely difficult. There is also a suspicious phenomenon called round-tripping. Tech giants invest in startups who then use that capital to buy chips from the investors. This creates an illusion of revenue growth. It looks like organic demand, but it is actually just money circling within the same ecosystem. Investors reading financial reports may be misled by these inflated revenue figures, unaware that the underlying demand is artificially supported by vendor financing. The risk is compounded by market concentration. Just 30 companies related to AI now account for nearly half of the entire market's value. This lack of diversification means that if the AI sector stumbles, it could drag down the entire global economy into a deep recession. If the broader economy weakens, investors will quickly retreat from high-risk assets like AI, potentially causing the bubble to burst very suddenly. We are standing on a precipice. The technology is real, but the financial valuations may have detached completely from economic reality and logic. So, is it a bubble or a revolution? The answer likely lies somewhere in the middle, requiring caution rather than blind enthusiasm. Smart investors should look for companies with tangible profits and avoid those surviving solely on hype and circular venture capital funding rounds. History teaches us that every technological revolution experiences a mania phase followed by a correction before true long-term value is finally realized. We are currently sitting at the peak of inflated expectations. The slide down into the trough of disillusionment may be just beginning. Despite the headlines, the physical world changes slowly. AI has not yet transformed the daily lives of most people outside the tech industry. Real-world implementation faces physical and regulatory hurdles that software cannot simply code away, delaying the economic impact that investors are banking on. There is also the social friction. As AI advances, resistance from labor unions and regulators will increase, potentially slowing down profit growth. Time is the ultimate test. The companies that can survive the coming cash burn will define the next decade of the global economy. Remember Amazon in the year 2000. It lost 90% of its value, but survived to become one of the world's largest companies. Conversely, many other hyped companies vanished completely. The challenge for you is to distinguish the future Amazons from the future failures. We must remain vigilant. The technology is revolutionary, but the price you pay for that revolution matters more than the narrative itself. High interest rates mean that the cost of capital is expensive. AI companies can no longer afford to waste money on unprofitable experiments. Hardware depreciation is another hidden risk. The chips bought today for billions may be obsolete junk within just 2 or 3 years. Wall Street is confused. One day they predict a boom, the next day a bust. You cannot rely on their headlines for safety. Ultimately, AI needs end users to pay for it. If the consumer economy weakens, subscriptions to AI services will be the first cut. A market correction might actually be healthy. It would clear out the scams and allow the legitimate companies to build on solid ground. Navigating this environment requires a steady hand. Do not let fear of missing out drive your decisions during these volatile market conditions. The engineering marvels are undeniable. We are building the brain of the future, but building a brain is an expensive and slow process. Adoption is happening fastest with the youth. They are growing up with AI as a standard tool, which secures its long-term relevance. Demographically, AI is necessary. As populations age and workforces shrink, we need automation to maintain economic productivity in the decades to come. In sectors like healthcare, the impact is profound. This is not just about chatbots. It is about saving lives and improving human longevity. Cybersecurity is another battlefield. AI is being used both to attack and to defend digital infrastructure, creating a perpetual demand for upgrades. This is also a geopolitical race. Nations are competing for AI dominance, ensuring that government spending will continue to support the sector. The rivalry between the US and China guarantees that investment in chips and algorithms will remain a strategic priority for national security. Industrial application is the next frontier. Moving AI from the computer screen to the factory floor could unlock trillions in real value. Agriculture, logistics, and energy management are all ripe for disruption. These are the boring but profitable areas where AI will truly shine. Economists predict that, if successful, AI could reverse the global trend of stagnation and launch a new era of high productivity growth. But for now, the wealth transfer is mostly one way. Money is moving from hopeful retail investors to the pockets of hardware manufacturers. Nvidia is currently the biggest winner, acting as the arms dealer in this war. Everyone buys their weapons, regardless of who wins. History calls this the pick and shovel strategy. In a gold rush, the safest bet is selling the tools, not digging for gold. We must cut through the noise, ignore the buzzwords, and focus on cash flow, profit margins, and sustainable competitive advantages in your analysis. If a company cannot explain how it will make money without using buzzwords, it is likely a risky gamble, rather than an investment. Investing now is like climbing a steep mountain without a rope. The view from the top is spectacular, but one slip is fatal. The market feels calm right now. Volatility is low and optimism is high. This is usually the moment when risk is most overlooked. The volatility index is asleep. Investors have become comfortable assuming that the tech giants will always keep the market moving upwards forever. But the concept of the black swan reminds us that the most dangerous risks are the ones nobody is talking about or expecting. A supply chain disruption in Taiwan or a regulatory crackdown in Europe could bring this entire machinery to a grinding halt overnight. Legal battles over copyright are also mounting. If AI companies are forced to pay for training data, their cost structure changes immediately. Content creators are fighting back. The era of free data scraping is ending, and the era of paid licensing is just beginning. The fire needs constant fuel. If the flow of investment capital slows down even slightly, the valuation multiples will contract very painfully. Valuations are priced for perfection. Any small disappointment in earnings reports will be punished severely by the market, as we have seen before. Holding these stocks requires a strong stomach. You must be prepared for drawdowns of 30 to 50% without losing your conviction. Diversification is your parachute. Do not put all your eggs in the AI basket. Balance your exposure with stable, non-tech assets. Consider defensive sectors like utilities or healthcare. Ironically, utilities may benefit from AI's energy hunger without the high valuation risk. Power generation is a bottleneck. Investing in the companies that provide the electricity for AI might be smarter than investing in AI itself. Think strategically. Look for the second-order effects. Who wins if AI succeeds, but also who survives if the AI bubble bursts? When everyone is running in one direction, it is often profitable to pause and look the other way. Contrarian thinking pays off. We are likely late in the economic cycle. Adding high beta tech risk to your portfolio now is a bold and dangerous move. Cash is an option. Having liquidity allows you to buy quality assets at a discount if and when the market eventually corrects. The digital transformation is inevitable, but the financial winners are not guaranteed. Remember that innovation does not always equal investment returns. Railroads changed the world, but most railroad investors went bankrupt. The internet changed the world, but most dot-com investors lost everything. Automakers changed the world, yet it is a brutally hard industry to make a profit in. Technology improves, but economics remain ruthless. Return to the fundamentals. Does the company have a moat? Do they have pricing power? Is their management team honest and capable? Without these fundamentals, you are building a castle on the sand. The tide of liquidity will eventually go out, revealing the truth. Build a forest, not a single tree. A diverse portfolio can withstand a fire in one sector and still continue to grow. Let logic be your compass. Do not let emotions drive your trades. The market is a mechanism for transferring wealth from the impatient. As the saying goes, the stock market transfers wealth to the patient. Patience in the AI sector means waiting for reasonable valuations. We may see a period of stagnation where prices go nowhere as earnings catch up to the stock prices. This is normal. Dig deeper. Look at the supply chain. Look at the software companies that have not yet been discovered by the mainstream hype machine. Small cap companies with specific niche AI applications may offer better growth potential than the trillion-dollar giants that are already saturated. Keep your eyes on the horizon. The AI revolution is a marathon, not a sprint. We are only in the first mile. Pace yourself. Do not burn out your capital in the first lap. Preserve your resources for the opportunities that will arise later. The future is likely a hybrid one, where humans and AI work together. Invest in companies that empower humans, not replace them. Tools that enhance human creativity and productivity will have the most staying power because they face less resistance from society and unions. Education technology is another sleeping giant. Personalized AI tutors could revolutionize how we learn, creating massive value for specialized companies. The market for education is in the trillions. Capturing even a small slice of that with AI efficiency is a massive opportunity. Drug discovery is perhaps the most exciting. AI can simulate millions of chemical reactions, cutting years off the development of new medicines. This is where the bubble talk becomes irrelevant. If a company cures a disease, its value is real, regardless of market sentiment. Smart cities and energy grids are next. Optimizing energy consumption with AI is critical for our planet and profitable for investors. Green energy and AI are twins. AI needs energy, and energy grids need AI to manage the complexity of renewable sources. Document your thesis. Why are you buying? What would make you sell? Writing it down prevents emotional decisions during market panic. Keep it simple. If you do not understand the product, do not buy the stock. Complexity is often a mask for fraud. Listen to earnings calls. Pay attention to the tone of management. Are they confident, or are they dodging the hard questions? Free cash flow is the truth serum of the stock market. Accounting tricks can hide losses, but they cannot fake cash in the bank. Your goal is to sleep well at night. If your AI investments are keeping you awake, you have taken on too much risk. Balance is key. Allocate a portion of your portfolio to high-growth AI, but anchor it with solid, boring, dividend-paying companies. Read history. The names of the companies change, but human psychology and the cycles of greed and fear remain exactly the same. We are in a loop. Understanding the dot-com bubble helps us navigate the AI bubble. Do not ignore the lessons of the past. To summarize, the bull case has borne merit due to real infrastructure. The bear case warns of high costs. The recession risk is real. Now it is up to you. Weigh the evidence. Assess your own risk tolerance. Make decisions based on data, not hype. We want to hear from you. Do you think AI is a bubble about to burst, or the greatest opportunity of our lifetime? If you found value in this analysis, please destroy that like button. and subscribe. It helps the algorithm share this knowledge with others. Macro Money Talk is dedicated to bringing you the truth about the economy, stripping away the noise to reveal the financial reality. Check out our other videos on the channel for more deep dives into the stock market, real estate, and global economic trends. Thank you for spending your valuable time with us today. Invest wisely, stay curious, and we will see you in the next video. This is Macro Money Talk, signing off. Remember, in the world of investing, knowledge is the only currency that truly matters. Goodbye.